radio for a really great future. We're talking real money.
Be scared. Be very scared, like Tom is. What are we scared of? AI. That's what we're scared of. Today we're going to talk about AI. AI and how it might impact your bottom line and some of the weird stuff that people are telling us to ameliorate our concerns about AI. Hi, AI. I'm Don McDonald, along with Thomas Charles Koch II, hanging out in the 90-degree studio in 20-degree Seattle.
Very weird. I hope it doesn't open. The wind's going to blow out, like it does when there's a pressure difference.
Oh, yeah, you got a pressure gradient. You got a temperature gradient there.
It'd be crazy. So, yeah. You got the sauna in here, and next office about 25 degrees. So, weird.
We are so thrilled you have chosen to go to all the effort to go to your favorite friendly podcast service like Apple Podcasts or Spotify or iHeart or Amazon or whatever it might be and pick us out of all the other money talk shows out there to listen to today. We are deeply and truly honored, are we not?
Absolutely, 110%, sir.
Yes, we are. We are so honored. And we want to try to put things in perspective, which is what we do about everything financial. You've probably heard or read, I don't hear anymore. I read all my news. I don't listen to news. I don't watch news. I only read it because I can't take it in real time. I just can't. It's overwhelming. So you've probably heard Elon the Musk talk about how, don't worry about AI. Don't worry. It's going to take your job. But we Silicon Valley billionaires, or maybe soon trillionaires, we're going to take care of you. Yes, we're going to give you a regular check, even though you're not working. Now, come on. When in history have big corporate giants actually shared their wealth with the little guys?
Yeah, and when in history have extremely wealthy people handed out all their... Now, they've done some charitable acts, I'll give you that.
Charity's
Carnegie
different.
and the like.
Charity's different.
Oh,
because
completely
charity
different.
is, you get to pick your philanthropy with there's an attitude that, and you see it with all kinds, even very generous people like Bill Gates, you still see, I want to pick what the money's used for. I don't want to give it to you and let you do whatever you do with it.
And this comes right after Mr. Musk suggested people don't need to sock away funds in their 401k anymore. Why? Because AI will make the scarcity of money a thing of the past. Here's the quote. If any of these things that we've said are true, saving for retirement will be irrelevant, Musk said. He speculated that AI could transform society, creating an abundance of resources that would grant everyone a universal high income and the ability to, quote, have whatever stuff they want.
From where will this universal high income be paid? From whose pocket are we taking this $50,000, $60,000, $100,000 a year check that we're going to give to those people who were left unemployed by AI?
Doesn't get into the specifics, simply tells you that we're going to be so rich and in so little need of output because the computers will doing it all that we'll just be sitting back eating bonbons on a sunny beach somewhere.
I seem to remember occasional proposals for like a billionaire tax or a multi-millionaire tax.
Well, there's one under consideration, I think, in California, and certainly here in Washington. I think there's a millionaire's tax that's under consideration as well.
And I seem to remember that the vast majority of those multimillionaires and billionaires are opposed to sharing their wealth with the riffraff.
Am
I remembering correctly?
In addition to what they already share, yes, I don't think they're excited. You've seen people, by the way, yes, they have relocated from one state to another where state income taxes have become burdensome to, and they believe, to them, or capital gains taxes. So they have moved from, those places that are charging more in taxes to places that are charging less. So, yes, it's definitely happening. They're voting with their feet.
Well, and it's funny because we have a very short memory. But as you probably know, we've talked about it. We talk about our TV viewing habits. I have been rewatching Mad Men. Apparently, I did not watch the 7th season at all because everything in season 7 is brand new to me. I must have missed that one. It must have been a delay or something.
I think people panned it at the time, so I don't think a lot of people. I think fewer people watched it.
It's weird.
I think it is unusual. Yes. Mm-hmm.
The top tax bracket in the 1960s was.
I'm going to say 60-something%, right?
You are not even close, sir. In the early 1960s, from 1954 to 1963, about the time we were born, the top marginal rate in the United States of America was 91%.
You imagine?
You got to keep 9 cents out of every dollar you made at the highest income level.
And what's the top marginal rate today in England, for example? I think it's still extremely high, isn't it? I mean, it's far higher than it is in this country.
I'm sure it's high. Let's find out. Let's do some searching.
Well, while you're doing that, I think it's interesting that Elon Musk said this. I think more interesting is how people responded to it, because Business Insider did a survey of their readers, and 94% said they would stick with their savings plan rather than bet the farm that an AI revolution would make it moot. In other words, they said that's great. I hope it comes along, but I'm going to just keep putting the money away and investing it kind of for the long haul.
The wisdom of crowds. You got to love them.
94% is that. We can pretty much say that's a super majority.
Yeah, I think that we've kind of figured out that that's a bunch of hooey, as my grandmother used to say.
Well, there are others that responded to this from the Boston College Center for Retirement Research. Most Americans should absolutely ignore these comments. Musk's speculation sends dangerous and misleading message.
To answer your question,
yes,
the top marginal rate in Great Britain is a lot lower than you think.
Really?
Yeah.
How much?
45%.
Okay. That's still a third higher than the United States.
No. No,
the
ours
top was 37 or 39.
37, but if you add in
third higher, yeah.
If you add in the 3.8,
yeah, okay.
Net investment,
closer.
You're getting to 41%, so it's pretty close.
Yeah, it's not that far away. By the way, somebody also pointed out that other technological revolutions haven't boosted wealth equally across society in the past, and that a potential universal basic income, like what Musk is suggesting, would take a coordinated effort from government, not tech leaders. I don't think this would come from Silicon Valley. This would have to come from Washington, D.C.
Yes, but to make it happen, it would require an onerous tax on the wealthy and on corporations, which is going to be vociferously, is the word I meant to say, opposed.
Yes, of course. Yeah, they're not gonna like that. And let's just unpack this just briefly. I don't think this is serious. It may have been a serious suggestion.
I just don't want to get people's hopes up.
No, but I think as in anything, as we suggest, as you know, in investing, no matter what the future looks like, I think you should diversify. And that means you've got to set something aside. That means you can't count on the government or technology to come in and rescue you, or for that matter, the Tooth Fairy or Santa Claus. So I think that's number one. Number two is, as the article points out, and I think they're spot on, remember when the internet was going to be, just the panacea for so many things, going to make life so much easier. Now it has made life easier. I'll grant you that. Made easier to spend on Amazon, made it easier to gamble. There's a lot of things that it's made easier, but I'm not sure it's really revolutionized income the way that some might have believed it would. And then here's the third part. When you read things like this, I often hear from people saying, well, I don't really save anything. I don't do anything. It'll work out. My life will work out. And let me tell you, somebody talks to a lot of people at 55 who are still trying to get started. Yeah, it works out, but maybe not the way you want it to work out. So my suggestion would be there. By the way, I brought this up with our advisory staff a couple of days ago just to see their reaction. They thought it was kind of silly. They also pointed out something I think should not be underrated, and that is people they need work not just for the income, but they need work for purpose. They need work to get out of bed in the morning, because otherwise, what motivation do you have, really? I mean, so, and this is something we've talked about ad nauseum when it comes to retirement. So again, this is not to be, in my mind, taken seriously. And if you're saving, keep on saving. If you're not saving and investing, get started. I've always say take one step first to get rolling, and tune out the noise. This would be, for me, a lot of noise.
Yeah, and it's an interesting math issue, too. I ran the numbers on just a minor, tiny little universal income only for adults. Just say it was just for adults, and it was just $1,000 a month.
Yep, so $12K a year.
Not going to keep you alive. It's just going to help a little bit. You're still going to have to make money somewhere else. It would add, the U.S. would need an additional $3.1 trillion in revenue. Our current annual revenue, it's $3.1 trillion. Did I say trillion?
You said trillion with a T, yep.
Currently, it's $5.2 trillion.
So almost a double. I mean, you need to, add that much again and half of it again.
Exactly. Which means basically tax rates have to increase about 80%.
And that generally, I found in a political situation, not very popular. People generally don't vote for those kind of, I'm being facetious here, they never vote for any tax. I want to pay less. So
I see the chance of this happening about the same as the fabric manufacturers in the 18th century sharing their wealth with the contracted weavers who were hand looming fabric when they all got put out of work.
There is one place
going back to the Luddite period.
Exactly, which, I'm barely
That's
escaped.
one of your favorites.
Oh, I'm still living it. There is one place where Mr. Musk can apparently save you money and help your future, and that is at Ryanair, which now features the big idiot seat sale, as Ryanair is in a dispute with Mr. Musk over using Starlink on its planes and whether they create drag or what the rest of it. So
is he the big idiot they're referring to?
Yes, he is the big idiot seat sale. So Ryanair helping you out there with Elon Musk should you want to get the big savings.
Oh, that's funny. He's always feuding with somebody, isn't he?
I know. He's one of those people that needs it. They've got to be engaged that way.
When you're 70% of the way to being a trillionaire, though, I guess you can afford to do anything you damn well please.
Which he will be soon I imagine when Starlink goes public here.
SpaceX,
pardon me, Starlink.
Yeah.
Yeah, when they go public, he'll be a trillionaire, I got to imagine, right? I would think.
Unbelievable.
I don't know. It is unbelievable.
Truly unbelievable.
Yeah.
Wow. Anyway, we love questions. One of our favorite things to do is answer your questions on the podcast. We have a Friday podcast that's totally devoted to spoken questions that you send in at talkingrealmoney.com. If you type them up, then they all go into Tom's little tickler file there, where he tickles the paper all day long.
Got to do something to need purpose, right? Got to have something to do there. Yeah,
he's got a little paper fetish.
I know. Tree killer. Just call me the tree killer. So my war on trees, as one writer so eloquently put it. Yeah. All right, from Raleigh, North Carolina, Karen writes, I love your show and have learned so much. I have a Fidelity HSA, which is invested in FFTHX, the Fidelity Freedom 2035. So that's a target date fund that Fidelity operates. The asset allocation is listed in the fund as 40% U.S. equities, 30% international, 35% bonds, and plus or minus 5% short-term debt and net other assets. She asks, can you explain what is short-term debt and net other assets?
I don't know.
Short-term debt is
short-term debt is short-term bonds.
Yeah, like issued
let
probably
me
by
look
the
up the fund. I was trying, but my screen
net
froze.
Other assets, that could take in a lot of stuff.
Yeah,
that's
what I'm going to go.
Collection of Pokemon cards or something. I don't know.
I'm trying to figure out why she's using Fidelity Freedom.
This is in her HSA. The choices may be limited. I don't know.
Yeah, the choices, because that is a flippin' expensive fund.
How much is it?
64 basis points for a target date fund.
That
seems
spendy, yeah.
Hold on, I got to pull up.
But what is short-term debt and net other assets?
I'm looking at their darn portfolio, and my computer just slowed down.
Boy, if you can't throw a few things in there, really.
We have it says that it's 0.6% in other on Morningstar.
Short-term debt and other net assets.
Yeah, short-term debt's going to be included there. Holdings are, whoa, what in the heck do they own? This is one of the stranger things. Okay, here we go. It's a fund of their other funds.
Yeah, that's not a surprise because most people put their
here's
funds
what we
together
have.
that way.
It's a lot of stuff. I think the other may be Fidelity Intrinsic Opportunities. That may be it. Because I can't figure out what intrinsic opportunities.
Tell us, Don, what is
really...
an intrinsic opportunity?
No, it's equities. They're just a bunch of equities, so that one's not it. I'm just looking at the list of funds, and they're all just pretty normal funds. I have no idea what other is. She stumped the band.
Short-term debt and net other assets.
Well, short-term debt is going to fall under the fixed income portion. So 32% of the
bonds.
portfolio is in bonds or cash. So actually, we've got about a third in bonds or cash, about a third in U.S. equities, and about a third in non-U.S. equities.
But it's the 5% in short-term debt and net other assets, Don.
But that's what I'm saying is the short-term debt is going to fall into the fixed income. So the net other assets are really that 0.6%.
And we don't know what those are.
And it's so tiny.
They're hidden behind a curtain somewhere.
They are
0.6%. That's a pretty small number.
They have some actual U.S. government bonds, some 10-year notes, and some long bonds. And then they have a portfolio of funds. Fidelity investment grade, emerging markets, large cap, growth company, international value, overseas, international growth, stock select large cap value, long-term bond, value discovery, opportunistic insights, whatever that is, international developed, blue chip, large cap value.
Remember when it was a country nearby ours?
It wouldn't be inflation protected bonds, emerging markets, all sequitur, small cap, international small cap. So they must have a little bit of something in one of these funds, some sort of an alternative asset within one of these funds that we're just not going to be able to dig down and discover.
Sorry, Karen, you stumped, as Don said, the band. Michael from Paulsbo, Washington, has a kind of an unusual question. Tom and Don, I seem to have overfunded my child's 529, wondering if I can establish 529s for both my wife and I and transfer some funds from my child's 529 to ours. Would we be able to roll over our 529 money to Roth IRAs in 15 years, provided we're still generating income at that time? Well, just to fix the last part, your income has nothing to do with rolling the money over to the Roth for somebody else. That person that is receiving it has to have income, has nothing to do with your personal income. Part two is a 529 is owned by you. It's not owned by your child. Your child could be the beneficiary, which you could change, by the way. So I'm a little confused as to your wording here, establishing one for both my wife and I and transferring some funds from the child to ours, because the 529 you've opened is yours. That's your fund.
No, but he's talking about the child's the beneficiary right now.
Yeah, the beneficiary, but it's still your 529.
Right,
and he
for
can
my daughter,
it's still
open
mine.
One for him and one for his wife.
Okay, but there wouldn't be two new ones. There'd only be one new one, because the one he still owns that.
No, but he could make himself the account owner and the beneficiary.
Yes, he could do that. Mm-hmm.
So he could have three different accounts. He could have a 529 where he was the account owner and his child's the beneficiary.
Overfunded. How much can you put in? I forget the max you can put in a 529 every year, but it's not an insignificant amount, I don't believe.
Let me look here. What is the
But you could do it that way, I guess. Yeah.
Oh yeah, there is no limit.
I thought there was a limit. I thought there was an annual amount you could put in.
No, really, it looks like the only thing is, some states have a lifetime aggregate contribution. Oh, you hear that familiar sound? The buzz in the background, Tom?
My! Get out there and stop those people. That's horrible.
It's a leaf blower.
Oh,
in the middle of the show.
In the middle
and
of the
I have a. This is how loud these darn things are. My office is soundproofed, padded, and it still roars right through the walls. I hate
and
that.
our listeners will understand why it's both, especially the padding part.
Yeah, exactly.
So
no,
this
there's
is a
no
little confusing. This is a little confusing.
No.
So I don't know why it would be overfunded.
No, I don't see any contribution limit.
Yeah.
Maybe I'm wrong. Some plans may cap them. The states may have a lifetime limit, but that starts. The lowest I can find is $235,000.
So if you've overfunded that's pretty hefty.
All right, these questions are not good today. I'm not liking them.
I'm sorry. Let's try this one.
You're doing a bad job with your paper.
Fort Collins, Colorado. John writes us, Tom and Don, I'm considering moving my taxable portion of portfolio to Vanguard Tax Managed Balanced Fund from the three existing funds, Wellesley, Wellington, and a Target 2020 fund. Total amount is about $900,000. The money is equally divided in those three funds. I have the same amount in my standard IRA. I'm 66 now, quite concerned about the distributions from the taxable account this year. $75K, he says. Once I take Social Security, I will no longer need the distributions from the tax account, or very little. He does point out that at 73, he'll have to take RMD. So my question...
Yeah. I mean, I like the tax managed balance. It's a good fund.
Would the Vanguard Tax Managed Balanced Fund be a good choice for this discussion for my taxable portfolio only? The IRA portion is a target date fund of 50-50 and will remain the same. Risk quiz is 50, and this fund has a 50-50 balanced allocation. So
well, here's the problem. Here's the problem. Because it's a balanced fund, there will still be distributions of income. Because they can't avoid distributing the income from the bonds. So you're going to
have that. That's going to be a taxable event.
Yeah, you're going to get. I mean, they have. Let's see. For example, they distributed 27 cents a share on $50 shares in December for the quarter.
So still fairly relatively small number, but yes.
Yeah, but that makes it $1 a year on 50. So we're talking
5 would be 10%. No,
5%.
No, less than that. 10% would be $5. So
2.5%. Yeah, about 2%.
So
2%.
Yeah. So But in the big picture, I'd prefer to see you in the balanced fund instead of Wellesley and Wellington. I'll put it that way.
Yeah.
I think that's a better option. So I'd be okay with that, I guess.
Here's what I think.
Look at the taxes, though.
Here's what I think the issue, though, becomes. Is he taking the best advantage of his different types of accounts?
That's a fair question. In other words,
because you need to hide
the right
the income.
Yeah,
you need to have the right assets in the right accounts. So, for example, if there's a way to put all your bonds over in your IRA.
Good point.
And all your equities in ETFs in your taxable account, you accomplish the same thing at a lower cost. With greater efficiency, by the way.
And he says he has $900K in each one of them. So if you wanted 50-50, you could put the $900 in the IRA in BND for that matter.
Right,
and then
exactly.
You could put all stocks in the other one. Now, the problem is going to be
then all those bond
distributions.
income distributions are not taxed or they're delayed. And because of ETFs, you're going to get very little in the way of capital gains distributions at a fraction of the price of even the tax-managed balanced fund.
But the problem is going to be watching one go way up and the other one go down a lot from time to time. It'll be your behavior have to be modified there. It'd be hard. I'll put it that way. But that would be the right approach. Catherine writes us from Newcastle. I'd like to find out where I can see the 2024 returns for Vanguard mutual funds.
Morningstar.
Pretty easy. You go to Morningstar, type in the ticker.
Yeah, and any of them. Type in the ticker for any fund. Like, for example, I'm on the Vanguard Tax Managed Balanced Fund Admiral Shares.
Yeah.
And I go to the Performance tab, excuse me, and look at 2024, and the total return for that fund for 2024 was 12.17%.
So, and you can do that basically with any exchange-traded fund or mutual fund. Morningstar, you can type it right in. You don't have to pay anything for that, and it's pretty easy to see what the returns are.
It's a wonderful resource for facts. I don't pay any attention to them for opinions, but I do for facts. And
they issue a lot of opinions, many of which we sadly have to disagree with. All right, just about out of time here, but I do want to mention Don insists, as you know, that I go on regular and expensive vacations. I've got another one coming up in April. I will be in the desert, but here's the good news. If you want to meet, I'm going to take a day. Why is that funny? I want to take a day.
You know why it's funny? Because,
why is it funny?
Because here's Tom's going to go, and I can write this off.
No, I don't write them off. I didn't write off any of the ones the last few years. Nah. Anyway, I will be in
you're not doing very good tax
No, I'm not. Scottsdale, Arizona on, the 7th of April. I know it seems a long way off, but if you want to have a meeting, I take a day where I meet with people. I've already lined up a day office there. That is April 7th in Scottsdale. If you want to do that, you just go to Talking Real Money, click on Meet an Advisor, and say, I want to meet Tom in the desert at high noon. No, it doesn't have to be high noon. But so if you want to meet me, you have to do that. So love to see you. Let me know. We do a full review of your portfolio, sit down and chat about whatever issues you've got. I'm talking financial issues here, and glad to do it. So that, again, April 7th.
And if anyone has a plan for eliminating gas-powered leaf blowers from the face of the earth, please send it along at talkingrealmoney.com on the contact form, or you can send questions in there too.
I believe California is they're going to be gone in a year or two in California. They're on the list. Pretty sure I'm right.
It's off in the distance right now, but
okay,
I hate them so much. I mean,
that's the first thing I would outlaw as president. So,
and you can get a pretty decent electric one.
Oh, I've got an electric one. It's quite quiet. Yeah.
Well, no, but even for the professional yard care guys, they can get the big industrial ones that are electric. Yes, you do have to carry some batteries. Yep. You have to plan ahead a little bit, but you still have to buy gas. So, and it would save us all a lot of grief. Would you all switch over? Come on.
It's not just the pollution. It's the noise pollution.
It's not even the pollution that bothers me. They're small. There aren't many of them. But it's the noise. I mean, come on. They came through 4-inch thick padded walls in my little psychiatric ward here.
Don't make him use the pads. All right. Also want to mention Retire Meet. For those of you who are not in the Seattle area, which we think is sad, and can't come to Bellevue on March 7th.
Trust me, all of us don't think that's sad.
Oh, okay. I'm just putting that out there.
Those of us in Florida do not think that's sad.
We have the virtual. Yeah, you can see the whole thing right online. Either way, go to retiremeet.com. That is
Wait,
Saturday,
does that mean I don't have
7th.
to get on a plane? I can just virtually do it?
Sir, we took a vote and you were voted off. You don't have to come to Seattle ever again.
Really? Not breaking my heart, you realize, right?
It's not. So anyway, sign up today. Join us. We'd love to see you either in person in Bellevue or online, retiremeet.com. How's that?
All right. And again, send us your questions. Just go to talkingrealmoney.com, click on the contact form, type them in or speak them in, because we want to help you by doing that thing we do, which we refer to as Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Wealth, a fee-only registered investment advisor. Please see Apella Wealth's ADV Part 2A on our website for information regarding Apella's fees and services. Apella Capital, LLC, DBA Apella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Apella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.